Every few years, something extraordinary happens in the Indian stock market. A handful of stocks quietly multiply investors' money 2x, 5x, 10x, or even more. But very few people see it coming. By the time CNBC starts talking about these stocks prominently, the easy money is gone. Our co-head of research, Rahul Shah, has spent years decoding this mystery. Why did a select few stocks turn rupees 1 lakh into rupees 5 lakh, rupees 10 lakh, or even more over the years, while thousands others went nowhere? It wasn't just good management or great products. Something else was at work. In fact, some of the biggest fortunes in the Indian stock market history weren't made by buying the established blue chips everyone already knew. They were made by spotting what Rahul calls the next gen blue chips. Think about stocks like Titan, Bharti Airtel, Aisha Motors, Page Industries, Bharat Electronics. Today, every investor can explain their success. There are stories online that say if, instead of buying a bullet bike, you had invested that money in Aisha Motors stock, you could have made a fortune. But tell me one thing, was it so obvious in the beginning? Aisha Motors was a struggling engineering company back then. Very few investors had the confidence to put their money in such stocks. Same was the case with Bharti Airtel. It was battling chaos in one of India's toughest industries. Titan was a risky bet in its early days, and so was Page Industries. But for investors who recognized what was happening early, the rewards were life changing. While analyzing many such companies, Rahul discovered a unique pattern that consistently appeared before these companies became market leaders. It appeared in this jewelry company just before its stock jumped by around 7 times in just 2 years. It appeared in this retail company whose stock went up 10x in less than 5 years. It also appeared in this electrical equipment company just before its stock shot up by 5x in 4 years. The same pattern appeared in countless overlooked companies before they became giants of today. Rahul believes this pattern can help investors identify tomorrow's blue chips before they become obvious to everyone. Because once these stocks become obvious, a bulk of the wealth creation has already happened. What matters is finding them before the crowd does. Today, Rahul will reveal why a handful of companies become India's next blue chips, while thousands never make the leap. The surprising pattern Rahul found before some of India's greatest wealth creators began their biggest moves. Why Rahul believes the same pattern is appearing again today in the new generation of companies. If Rahul is right, the next generation of blue chips may already be taking shape in today's market. So let's find out exactly what he has discovered. Rahul, welcome.
Well, thanks for inviting me. It's a pleasure to be here.
Rahul, you're everywhere from CNBC to the Economic Times, and half a million readers follow your research through email. So clearly, a lot of investors pay attention to what you have to say. But today, I'm going to ask you some tough questions because, frankly, I'm tired of hearing grand promises about finding the next multi bag. Every few months, someone comes along claiming they've discovered a hidden formula, a secret pattern, a revolutionary framework. Most of it turns out to be cherry picked examples with clever storytelling. So, whenever I hear phrases like discover the next winner, find tomorrow's blue chip, identify the next multi-bagger before everyone else, my skepticism immediately goes up. I start asking questions. Can this actually be done? Or are we simply taking successful companies from the past and creating a story around them after the fact? So don't expect an easy interview today. If there's real substance behind this idea of next gen blue chips, I want to see the evidence. And if there isn't, we'll find that out too. So let's begin.
Well, your skepticism is justified. I agree. Hindsight makes everything look obvious. I'm not claiming I can identify which company becomes the next Titan or the next Aisha Motors, but I can certainly find companies showing a hidden pattern that often precedes a major breakout. You see, I've studied decades of market history to uncover this pattern hiding in plain sight. This pattern is so consistent that it forced me to rethink everything I thought I knew about investing.
What kind of pattern are we talking about? From what I've seen, most patterns disappear the moment you test them across different industries and different time periods. So, what convinced you this one was real?
When I began studying India's largest stock market winners, I expected to find success concentrated at one extreme, either very early or very late. Instead, I found something unexpected. Some of the biggest fortunes were often created during a transition period, a period when a company had already discovered something important, but before the broader market fully understood what was happening. The business was no longer an experiment, yet it was not an obvious blue chip either. It occupied a strange middle ground, a place most investors ignored. In many cases, this was where the steepest wealth creation occurred. That discovery sent me down a rabbit hole. I wanted to understand what separated companies that successfully transitioned through this narrow window from those that didn't. That's when I stumbled across an idea that completely changed how I look at stocks. The surprising part, the answer did not come from finance, it came from biology.
Wait a second. Most equity researchers spend their lives reading annual reports and investor presentations. Yet you are explaining stock market wealth creation using some concept from biology. That isn't normal investing framework. Where does this idea come from?
Well, the answer is rooted in a lesson my father taught me many years ago. You see, I was young and ambitious, talking to him about the positions I wanted, the success I wanted, the future I imagined for myself. He listened quietly and then said something I'll never forget. Always deserve first and desire later. At the time, I did not fully appreciate what he meant, but those words shifted my focus. Instead of obsessing about outcomes, I became obsessed with learning. I wanted to deserve success before chasing it. So that quest eventually led me to the work of Charlie Munger.
The multidisciplinary thinking idea.
Exactly. Munger believed that if you want to understand reality, you can't rely on one discipline. You need mental models from many different fields. That idea changed the way I approached investing. I started reading everything I could get my hands on: history, psychology, biology, decision making, systems thinking. Even today, when I'm traveling on Mumbai's crowded local trains and most people around me are scrolling through social media, I'm usually reading on my Kindle. And over time, something interesting happened. The more disciplines I studied, the more investing started looking less like finance and more like evolution. Specifically, an author named Eric Beinhocker and his work on how wealth is created in an economy gave me a new insight that changed everything. For years, I searched for a framework that could explain why certain companies become dominant. Eventually, I found one, not in an economics textbook or any investing manual, but in one of the most powerful ideas ever discovered: evolution.
That's interesting. Tell me more.
Well, think about nature for a moment. Every ecosystem is packed with competing species, thousands of them. Some thrive, some just get by, and some vanish completely. And here's the thing, it's not random. The environment decides who wins. When conditions shift, new species rise and old ones fade, even ones that seemed unbeatable a decade earlier. Now, the more I studied this process, the more I realized the stock market operates the same way, because businesses don't compete in isolation, they compete inside environments. And when those environments change, the rules of success change too. Now, that insight unlocked something important. The companies that become tomorrow's blue chips are rarely the companies that dominated yesterday. They were often the companies that adapted fastest to a changing environment. The only challenge was recognizing this change before everyone else does. That's where my research took an unexpected turn. because after analyzing hundreds of companies, I discovered that nearly every major blue chip company appeared to follow the same hidden sequence on its way up. Titan went through it. So did Airtel, Aisha, Page Industries, Bharat Electronics. All of them, in their own way, followed the same path. And a few companies I'm tracking right now look like they're walking down that exact same road. I eventually gave this sequence a name, the next generation or the next gen blue chip code. I'll be honest, when I first spotted this pattern, I didn't believe it myself. It seemed too simple. Surely businesses worth thousands of crores could not all be following the same roadmap. But the more examples I studied, the harder it became to ignore. Different industries, different decades, different management styles, and yet the same sequence kept showing up. At some point, it stopped looking like a string of individual success stories and started looking more like a process, a repeatable process with three distinct stages. I call them variation, selection, and amplification, or VSA for short. Now, once you understand these three stages, you'll begin seeing opportunities most investors never notice.
Okay, let's slow down here. If I'm an investor trying to spot a future blue chip early, what does this actually look like in practice? Walk me through each stage.
Sure. So, the first stage is variation. This is one of the most important growth phases for any company, but it's also the stage where 90% of failure occurs. Let me explain. You see, every great wealth creator begins as an experiment. A company tries a new product, tests a new market, plays around with a new business model. Most of these experiments go nowhere, and that's normal. At this stage, literally nobody knows what's going to work, not even the people running the company. For every experiment that succeeds, many disappear without a trace, which is why this stage can be dangerous for investors. The upside could be enormous, but the uncertainty is equally enormous. Then something important happens. The markets start voting on what works, and that's where stage two begins. So, stage number two is selection. This is where the winners start separating themselves from the crowd. A product gains traction, a service begins scaling. You see customer behavior changing, or one business model clearly starting to outperform the others. At this point, the company is not guessing anymore. It knows what's working, and just as importantly, it knows what isn't. And that's a massive advantage because uncertainty that defines stage one starts to collapse. The business has discovered something real, something repeatable, scalable, a winning formula. And this is where many future blue chips first begin emerging. The problem is, this is the stage where most investors sell too early, right before the biggest wealth creation begins in stage three. This brings me to stage three, amplification. This is where the breakout begins. The company stops experimenting and starts multiplying what already works. More locations, more capacity, new geographies, more customers, wider distribution. Same playbook, run again and again and again. The business is no longer discovering, it's amplifying. This is the company's first real step towards blue chip status. And that narrow window between discovery and amplification is what I call the breakout zone.
So, if I'm hearing you correctly, this is really the heart of your framework. Identify companies in their breakout zone.
Exactly. That's where some of India's most attractive opportunities have historically appeared.
So, how do you identify these opportunities? I mean, I've seen many companies with great products or services, but still nothing interesting happens in their stock prices. They keep stagnating for years. Am I missing something here? It would be better if you can explain this breakout zone with a real world example. Because what you've discussed sounds elegant in theory, But how does this actually play out in the real world?
Completely agree. A company can have all the ingredients for success and still not enter the breakout zone for years. To enter the breakout zone, it needs one missing piece of the puzzle, and that is a change in the environment. Let me show you what I mean. There's a company following Titan's playbook, but with a slight tweak. Instead of Titan's slow growth, this company is working on a business model that can scale faster. No wonder, in just a few years, this company has become one of the fastest growing players in its segment. But is this business model the only secret of its growth? Well, I would say no. The real secret is a massive change in the environment this company operates in. In an overly saturated market where most brands differentiated mainly by design, price, and regional loyalty, something subtle but powerful began to change. Customers started demanding trust as the primary product, and that shift changed everything. It pushed this company into its breakout zone. A stock that went nowhere for 2 years gained almost 7 times in just 2 years. What changed? The environment. The company already had a winning formula. The new environment simply gave it the opportunity to amplify it.
Wow. So, does that mean that when the environment changes, all the companies benefit from it?
Well, not necessarily. You need to evaluate companies through the lens of biology, not finance. In nature, when the environment changes, not every organism thrives. Only those that are already well adapted are able to take advantage of the change. The same is true in investing. Look for companies that already have a winning formula, companies that have proven products, strong capabilities, and a durable competitive advantage. Then look for a change in the environment that allows them to amplify those strengths. That's when the magic happens. All they need is a trigger, and often that trigger comes in the form of a changing environment.
Got it.
Let me show you one more company that entered its breakout zone. This company makes air conditioners and air purifiers, boring commodity products. The company was founded more than 80 years ago, yet, for most of its history, nothing remarkable happened. Then, the environment changed. You see, after the COVID pandemic, demand for real estate and work from home surged. At the same time, growing awareness of health, comfort, and safety led more consumers to use air conditioners and air purifiers. That was the environmental shift the company needed. Look at what happened to its stock price, a 5x gain in just 4 years. That's enough to convert a small sum of rupees 1 lakh into rupees 5 lakhs or 3 lakhs into rupees 15 lakhs. These are the kind of breakouts I'm looking for. Now let me show you one more. This time it's a Tata Group company. The company already had a partnership with Zara, one of the world's leading fashion retailers. Now Zara's fast fashion playbook was a proven success. So the company adapted that model for India and built a highly successful retail chain of its own. Today, it sells apparel, footwear, and accessories for men, women, and children. I'm willing to bet that you have shopped at one of its stores.
Zudio?
That's right.
But Rahul, what I don't understand is what was the trigger for Zudio's rapid growth?
Again, it was the changing environment. Indians are shifting from unbranded local stores to branded fashion retail. If you're buying online, you go to Amazon, Myntra, or Nykaa. If you're buying offline, you go to Pantaloons, Lifestyle, or Zudio. Zudio simply benefited from the shift in consumer behavior. It put its parent company firmly in the breakout zone, and it was a massive breakout. The stock went up more than 10x in less than 5 years. Now, I could go on and on with examples where a changing environment has pushed companies into the breakout zone. A luxury chain of hotels from Tata Group, a transformer making company, a leading private hospitals brand, a trusted NBFC company, a two-wheeler manufacturer. Different stories, Same pattern. The only real trigger behind these moves is a shift in the environment.
Rahul, I can see how your framework explains the past, but investors don't get rewarded for understanding yesterday's winners. They get rewarded for identifying tomorrow's winners. So, my question is, do you see conditions today that resemble the environments that created such massive growth?
You see, once you recognize this pattern, a far more important question emerges. What happens when an entire economy enters a new environment? Because that's when opportunities don't just appear one by one, they multiply. And that's exactly what may be happening in India right now. We are in the early stages of India's next great blue chip cycle. We saw how every major wealth creation cycle begins with a change in environment. Think back to the great periods of wealth creation in India: the post liberalization era of 1991, the infrastructure boom of the early 2000s, the pharma and export driven rally of the 2010s, post COVID rally of the 2020s. Each phase created a new set of leaders. Today, I believe India may be entering another such phase because of one dominant force: AI. Now, AI may create one of the most fertile blue chip creation environments we have seen in years. Most investors think investing in AI means betting on the next AI software company. But the biggest, most resilient investment opportunities right now are in hardware, heavy industry, and deep engineering. AI cannot exist in a vacuum. It requires a massive physical footprint, and it is triggering a multiplying domino effect across sectors that you can invest in today. For example, the power and green energy grid. An AI search query can consume up to 10x the electricity of a traditional Google search. To power this revolution, India's energy infrastructure is undergoing a massive overhaul. Another example: advanced robotics and warehouse automation. With the explosion of e commerce and manufacturing in India, companies are heavily investing in AI powered robots to handle high precision assembly lines. Then there's defense, aerospace, and drone hardware. From autonomous surveillance drones to AI guided missile systems, the Indian defense story is rapidly modernizing. Next, we have agritech and autonomous machinery. AI is moving into India's fields. We're seeing the rise of smart tractors, drone based crop monitoring, and automated irrigation systems. Another area of promise: electronics manufacturing. You cannot run AI without complex hardware. India's domestic manufacturing sector is booming thanks to the push for local electronics. Think high density circuit boards, advanced liquid cooling systems for high performance servers, and precision semiconductor testing equipment. The list goes on and on.
AI seems to be creating a lot more opportunities than what appears on the surface.
Exactly. And when you link it with India's heavy push for self reliance in manufacturing, you have a force multiplier. For decades, India's growth story was primarily about consumption. But today, domestic capability is becoming a national priority. And whenever an economy upgrades its capabilities, new corporate leaders emerge. Now, add the catalyst of global supply chain realignment, and you're looking at a perfect environment for future blue chips creation in India. You see, for years, the world relied on just one main hub for manufacturing.
China.
Right, but things are changing fast. Right now, global companies are rethinking the strategy, diversifying production, and completely redesigning the supply chains. As manufacturing moves around the map, India is stepping up as a major winner, creating the kind of opportunities we could not have even imagined 10 years ago. The way I see it, we are still only in the first few innings of this transformation, which leads us to the most important question of all. If these forces are already reshaping the environment, which companies are prepared to enter the breakout zone? That's the question my research is designed to answer.
That's probably the question everyone watching is asking. We all want to know what you have discovered.
In my research, I've identified a handful of companies that appear uniquely positioned for this environment. I'm not talking about established blue chips. I'm talking about businesses that may still be in the breakout phase, businesses benefiting from major structural changes happening in the Indian economy right now. One company is helping enable India's manufacturing transition. Another is positioned at the intersection of AI and digital infrastructure. A third is benefiting from a long term defense modernization cycle. A fourth has quietly become critical to a rapidly expanding industrial supply chain. And a fifth appears to be riding one of the strongest premium consumption trends I have seen in years. These companies operate in different sectors, they face different challenges, but they share one important characteristic. Each appears to be aligned with a powerful environmental shift. And historically, that's where some of the greatest opportunities emerge.
Wait, so you're saying these are companies still in their breakout phase, not mature blue chips?
Right. And not small caps either. Small caps tend to be more volatile and unpredictable. If you study market history, you'll notice many mid caps in this phase before they eventually become the giants of tomorrow.
That's interesting. But by SEBI's classification, there are only 150 mid-cap stocks. So are you saying investors should focus their attention on just those 150 companies out of more than 5,000 listed stocks?
I think that's a smart starting filter.
Then why not simply buy a mid-cap index fund or an ETF? Why spend so much time and effort on finding that mid-cap stock in the breakout zone? Or as you like to call it, the next-gen blue chip?
Well, because a basket of 150 or even 100 stocks can only offer you average returns. If you want to outperform the market, you need businesses in the breakout zone. Businesses benefiting from major structural changes such as AI, manufacturing, defense, digital infrastructure, premium consumption.
Got it. A while back, you mentioned several companies that appear to be benefiting from these structural shifts. But why doesn't the market already see what you are seeing? Why do these opportunities continue to exist if the information is public?
So, one of the lessons history teaches us is that breakouts eventually become obvious. Once consensus arrives, the asymmetry often disappears. That's why timing matters. When only a few investors recognize a breakout, the potential upside can be significant. When everyone recognizes it, the opportunity looks very different, which is why investors should pay close attention today, because many of the structural forces reshaping India are still in their early stages. The environment is changing. A new generation of blue chips is already forming. And just like every cycle in history, it won't be the strongest companies that win. It will be the ones best aligned with the new environment.
I'll admit something. When we started, I was looking for an excuse to dismiss this idea. But what you've laid out today isn't a promise, it's a lens.
That's exactly the point. Now, I'm not claiming to know which company becomes the next Titan or Eicher Motors. This framework just tells you where to look and when. Because by the time a breakout is obvious, most of the wealth creation has already happened.
Rahul, thank you for this.
Thank you for the tough questions.
That's it from us for today.
Registration granted by SEBI, enlistment with BSc, SIA and RA, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors.
Hi, I'm Trupti David, Chief Operating Officer at Equitymaster. First of all, I want to say congratulations to you. You are just one step away from accessing mid-cap stocks in a breakout zone inside Rahul Shah's Mid-Cap Value Alert. As you may know, mid-cap stocks have historically outperformed large caps by a huge margin. As you can see, over the last 2 decades, the BSE Sensex has offered 2,327% return, but the BSE Midcap Index has offered a whopping 5,111% return. Meaning, if BSE Sensex turned an investment of rupees 10 lakh into rupees 2.42 crore over duration, the BSE Midcap Index turned the same rupee 10 lakh into rupees 5.21 crore. Here's the simple reason midcaps have crushed larger stocks over time. Many of tomorrow's corporate giants are hiding in the mid-cap universe today. After all, almost every blue chip stock was once a mid-cap. The next phase is often about scaling that success. In short, amplification. That's often when some of the most compelling investment opportunities emerge. If you can spot a mid-cap in a breakout zone before the crowd recognizes it, you don't just buy a stock, you buy a seat on the journey from emerging company to a corporate giant. With over 2 decades of experience in the market, Rahul Shah can spot mid-cap stocks at the cusp of growth. If you believe in the power of mid-cap stocks, then we invite you to try Rahul Shah's Mid-Cap Value Alert. Now, before I tell you how to access Mid-Cap Value Alert and all the stock recommendations inside it, let me quickly show you what our subscribers have to say about Rahul's research. Mr. Mayank Trivedi from Surat says, I am very impressed with strategies of Mr. Rahul Shah and have been following him from the last 3 years. I have strictly followed his strategy and have made good quality returns as compared to others. Mr. Amit Acharji from Durgapur says, past performance of Rahul sir in terms of responsibility and dedication towards guiding investors is awesome. Mr. Upendra Chadda from Mumbai says, I appreciate the recommendations under Rahul Shah's mid-cap stock recommendation service. I have benefited so far and intend holding the stocks as per advice from Equitymaster team. And here is what Mr. Priyank Upadhyay from Mumbai has to say. I am very much satisfied with the service and by the performance of the stocks in the portfolio. I am showing just a few messages here. There are so many of them. I can't show them all over here, but you get the idea. Now let me quickly show you what all you get inside Mid-Cap Value Alert. 3 next-gen blue chips in the breakout zone. You get instant access to our latest Mid-Cap Value Alert research report covering 3 mid-cap stocks in the breakout zone. Monthly recommendation reports. On or before the 15th day of every month, we will release a detailed recommendation report which includes new stock recommendations depending on the market conditions of course, latest views and updates on existing stock recommendations, information on emerging opportunities that we are tracking at the moment. All stock recommendations inside Mid-Cap Value Alert. Inside private members section of Mid-Cap Value Alert, you can access all the mid-cap stock recommendations from Rahul. For all the stocks under coverage, you get buy, hold or sell recommendation. Plus, you get regular updates and alerts about these stocks. You also get 24/7 access to a members-only website. Anytime, any day, you can log on to the website, read every report, every newsletter issue, review all the recommendations or even report a concern about your membership. Instant alerts. In case of buy or sell recommendations, you receive instant alerts through mobile and email. Full access to Mid-Cap Value Alert research archives. You'll also get unlimited access to all the research published under Mid-Cap Value Alert. This content alone is worth tens of thousands of rupees. But as a member of Mid-Cap Value Alert, you get full access to it right away. Intelligent Portfolio Tracker with Trends Report. With our Intelligent Portfolio Tracker, you can not only track your stock investments, but you can also get many interesting insights like what are the top stocks held by most portfolio tracker users, stocks where users are increasing stake, stocks where users are reducing stake, sector allocation trends, and much more. Equitymaster on the go. Now you can access Equitymaster on your smartphone through our mobile apps as well. Through the app, you can access the latest research reports, stock updates, all our e-newsletters, all other subscriber features on the go. a dedicated customer service team. If you ever have questions about your membership, send our customer service team an email. They will get back to you at the earliest and walk you through whatever you need. Or you can even call our customer service team on working days between 10 a.m. to 6 p.m. and we will be there to assist you in the best possible way. Now, coming to the most important question, what does it cost to join Mid-Cap Value Alert? Well, at Equitymaster, our only mission is to guide regular investors to build wealth with our unbiased and deep research. And we've been doing that for 3 decades now. That is why we've kept the cost to join the Mid-Cap Value Alert as low as possible at just Rs 10,000 a year, so that it is easily affordable to majority of investors in the market. But today, we don't want you to shell out the full price. With our exclusive offer, you can get 1-year access to Mid-Cap Value Alert for just Rs 1,950. That's an instant saving of Rs 8,050 for you. Now, at this point, if you have even a tiny little doubt in your mind, then let us give you Equitymaster's 30-day 100% refund guarantee. Try Mid-Cap Value Alert for the next 30 days. Act on all the actionable mid-cap stock recommendations inside Mid-Cap Value Alert. Thoroughly review all the research content that we've published under Mid-Cap Value Alert. And after experiencing all this, if you feel that you are not getting enough value, then just let us know. We will give you a prompt refund of every single rupee you pay today. So, you see, the control is always in your hand. And here's one more benefit for you. Lock in your second year for just Rs 95. Join now and you will receive an option to renew your Mid-Cap Value Alert subscription for second year at just Rs 95. There's nothing extra to pay today. When your first year ends, you'll be eligible to continue your subscription for another year at Rs 95 only, instead of a standard Rs 10,000 annual price. So don't miss this opportunity. With our 30-day 100% refund guarantee, there is absolutely nothing to worry. So if you're ready to tap into the power mid-cap stocks with Rahul Shah, we look forward to having you on board as one of our newest members. Just click on the link in the description below and secure your spot. We are excited to welcome you today.